The market is expensive, especially at the top with the names driving things higher. The S&P has a forward PE of about 23 times, and that's about as high as it gets. A market correction could happen, regardless of the economy. There could be a correction of 10%, could be a correction of 15%.
Well, welcome everyone to Rise Up. My name's Terri Kallsen. It's great to be back with you here again this week. Very excited to share with you really important information and new data to help you make better decisions. That's what we do here at Rise Up. It's our mission to bring you the real conversations to help you make better decisions about your portfolio and your financial plan so that you can achieve your financial goals. Just as a reminder, at the Wealthion, go to Wealthion /.com for a free portfolio review as we go through this. But I'm very excited. Joe Duran isn't with us this week. We really enjoyed him last week. I happened to be in Africa last week studying the Big Five. And if you recall, this show is all about the big three, the three big questions that our audience sends to us. But last week it was the Big Five in Africa, and I had a wonderful time. Giraffes, I saw rhinos, elephants, and it was just a wonderful adventure. And so I'm bringing back some of that adventure as we go through this today, because there'll be lots of questions, lots of concerns, but we're going to help you with that confidence as we go through it. But we do have two very special guests with us today, experts in the field. Back with us today is Kevin Grimes, the CEO and CIO of Grimes & Company. He's a CFP, he's a CFA, and he's such an expert at helping answer questions around your portfolio. Welcome, Kevin.
Thanks, Terri. Happy to be here as always.
You bet. And then we have Emily Wood, who's also a CFP and a wealth manager at Grimes & Company. She's been working with clients for many, many years and has been proactively helping clients work through these very difficult markets to navigate. So welcome, Emily.
Thanks, Terri, and welcome back.
That's great. All right. So we talked about the big three, which is the focus of this show, starting with the latest in the markets. It's really been a roller coaster. Just recently, we saw a downward trend in 5 of the last 6 days. But then yesterday and today, Apple's announcement of another $100 billion for manufacturing in the USA has really lifted some of the markets. And the president's announcement that most microchips will be exempted from his latest tariff. So we've got some good news here and some news that we need to understand better. We saw the markets bounce back today, but we've been discussing, Kevin, valuations. We may think there's a slight downturn this week, but we're still hearing experts say a downturn is coming. As a CIO, what are you thinking? Is it up or down at this time?
Sure. Well, look, the market is expensive, especially at the top with the names driving things higher. The S&P has a forward PE of about 23 times, and that's about as high as it gets. The S&P has also advanced 25% in under 4 months since the April lows. So the broad market seems overextended, and even from a technical perspective as well. We follow things like the Relative Strength Index, RSI, which is a short-term momentum reader, an oscillator. When you see readings over 70, that's a sign of a warning, could be a sign of a short-term market top. And about a week ago, we saw readings of 75. That's really high. We're seeing some highs in sentiment readings. So look, with this valuation backdrop, a market correction could happen, regardless of the economy. Markets are susceptible to outsized reactions to bad news when they're overextended like they are right now. So there could be some choppiness. There could be a correction of 10%, could be a correction of 15%. But unless there's an economic stress, like real stress, then those dips are likely going to be bought. So, some are concerned about the economy slowing, but remember, the Fed has a lot of bullets in the gun. And I fully expect the Fed in September to cut rates, could even be a 50 basis point rate cut. We'll see if the data permits that. Inflation is really the fly in the ointment. Problematic inflation could derail efforts to stimulate the economy, and that would be the worst case scenario. So that story is not going to be written until later this year. We're going to have to see what the impact is on inflation in the coming months, but nonetheless, we are going to get a CPI reading next week as well.
Yeah, so all this data is certainly very helpful. I just want to remind our viewers that, we've seen higher than a 10% drop, even this year when you've been with us each week. So just stay with us during this time as we go up and down through this volatility. But Emily, you're working with clients every day as a certified financial planner. How do you balance with your clients, the markets, watching for potential ups or downs, and making sure clients are prepared and they're still going to achieve their financial goals?
Well, I mean, maintaining a long-term perspective and then sticking with a plan, even through bumpy markets, is just critical to the success for investors. So, a huge piece of our job is that making sure clients have the proper allocation. So, clients with no liquidity needs and a long-term time horizon, they probably have a much more aggressively invested portfolio than maybe a retiree or someone who's using their portfolio as a current source of income. Those people, we want to make sure that they've got that appropriate liquidity so that we're not in a position where we would ever need to sell stocks when they're down to create that income stream. But having that longer term strategy in place, understanding it, having some confidence about that should dissuade people from making allocation changes and in anticipation of shorter term market adjustments like what we've seen this year.
Emily, I like to think of you as that financial coach in people's lives. We can all read the markets, we can try to predict what's happening, but you're the coach helping clients think through each life event they're going through, each phase, and helping keep calm and at least a peaceful reaction during this time. But let's move on to our next one. Our next big three story has several of the biggest companies calling their PR crisis teams Thursday morning. President Trump posted on Truth Social demanding the CEO of Intel resign, saying Lip Bautan is, quote, highly conflicted because of the ties he has with investments in Chinese companies. Intel has not currently responded to the call. Then President Trump is planning an executive order that would punish banks if they are believed to be discriminating against political conservatives. The president recently accused JP Morgan Chase and Bank of America of discrimination by refusing to take the personal business of some conservatives. Both have denied that has happened, and all three companies have seen their stock drop just recently. So, Kevin, let's just start with you as someone who is managing portfolios. Does the president targeting companies like this affect your decisions on what companies to invest in?
I mean, probably not, but it could. I mean, healthcare and some consumer staple stocks, like say the food industry, have seen a lot of headwinds with the MAHA movement. Make America healthy again. You've seen scrutiny from RFK and from Casey Means, who's the Surgeon General. They've taken aim at those industries. On the other side of the coin, no pun intended, the president has been crypto friendly, and that's been a tailwind to some of those assets. So there's an impact there. But in general, it's going to be pretty impossible to get in front of this president who moves very quickly with executive orders and tweets. I mean, for example, president just said he may put 100% tariffs on semiconductors unless you invest in the U.S. like Apple did. I mean, is that real? Is it just a threat? How do companies respond? You just can't manage around that. It's pretty hard, and it's probably an exercise in futility.
Yeah. So Emily, when clients are calling you because he's potentially accusing banks of these, how do you answer them, and what's the best path forward?
Sure. Well, like Kevin said, what the president says, I think the market is starting to take with a grain of salt. And so we don't, much like we don't want people to get too excited when things are good. We don't want them to panic when there's negative headlines around either an industry or a specific company. If anything, I will sometimes get calls where people want to be a little bit more opportunistic, and they're looking at something that might be beaten down in the short term because of these headlines and just shorter term market moves, but they think there's some longer term perspective there as well.
Yeah, I think just having the conversation with clients oftentimes leads to that rational decision. And that's why, again, having a financial coach is so important. Let's move on to then our last of the big three, asking the question, is manufacturing making a comeback in the US? This week, as we said, Apple announced putting another 100 billion towards manufacturing here in the US, most of it towards AI. There'll be a new manufacturing academy, a new state-of-the-art campus in California, and Silicon Valley, which is ultimately where I live, but this one may build a new one in Phoenix. So some of these top companies have promised to reshore certain manufacturing operations back to the US, including Ford, Intel, GE, Johnson and Johnson. I even heard Apple's going to create the glass cover of their Apple iPhone from Kentucky, which could be very good news for manufacturing. But Kevin, do you think we'll see a huge influx of reshoring if some of these sectors do what we think they're going to do? So because manufacturing, really goes across so many of these areas.
Yeah, I mean, reshoring and domestic investment obviously go hand in hand with tariffs. And this president has an erratic negotiating pattern that is now easier to understand. You place onerous tariffs on countries to encourage them to come to the White House, agree to a lower tariff level, and then commit to a large investment in the US. And you know what? It's worked. And now he's doing the same thing with the big tech companies. Just look at the Apple deal you just mentioned. These tech companies are lining up to invest in the US and to avoid tariffs and to get on the good side of the chief executive of our country. So energy, power companies, really anything involved with electricity generation will likely benefit because they will have to power all this investment. I mean, utilities are the best performing sector year to date, which is a little fun fact. 2 weeks ago on this show, or actually it was probably longer than that, maybe 3 weeks ago on this show, we were talking about uranium. We were talking about nuclear. It's the same line there that all this investment in the U.S. is going to need more power, more electricity. Drug companies are likely to reshore to try to get around tariffs, try to get the hometown exemption. But I don't know how investable a lot of this is outside of that. I mean, think about it. Is onshoring good? And it's not a simple answer. For me, the top priority is independence from a history of depending on China, which is a national security issue. And from that perspective, onshoring is great. And I'm a huge proponent of onshoring investment for that reason. We need access to rare earth. We need computer chips. We need drugs. We need critical items that are outside of China's reach. We need access to be able to access these things with an unlimited energy supply, basically, to try to stay ahead of the AI race with China. These things are absolutely imperative. But I mean, from an economic perspective, I mean, there's a reason why so many things are made overseas. It's just way cheaper. And we generally just can't compete because our labor is too expensive. So you can make more money you don't make more money by having a more expensive supply chain and a more expensive assembly process. So it's not an easy question to answer.
Kevin, when you brought up China, that is so important. And just coming back from Africa, which is one of the most mineral rich countries in the world, China has really made their presence known in the country of Africa. And every airport we went to, be it Johannesburg or Cape Town, these were oftentimes investments of the Chinese to really start to work forward in the country of Africa. And a lot of that is due to the mineral rich sources that they have, like we've talked about: copper, uranium, several others, platinum metal groups. They're all there. And so it's really interesting to watch in a country like that, how China is making their presence very known. Emily, is there a benefit for any of our clients to own any of these assets? Both minerals as well as some of the other Apple stock. We've talked about Intel, companies that are saying they're going to reshore, or does it matter?
I mean, I would look at the overall investment thesis of the company, but I think a company saying that, oh, I'm going to reshore in light of the current environment, it's probably not going to have a really significant impact on the company. I mean, these things are priced in so quickly that I don't see a reshoring announcement, having a dramatic impact on the stock price.
Yeah, well, I guess we'll wait and see, but it's not anything to run out and buy today. But we'll continue to watch and monitor this. For those of you, again, who are wondering about this and really want to make sure your portfolio can weather all of these ups and downs and the changes, is please go out to Wealthion and do a free portfolio review. And then you can talk to advisors like Kevin, like Emily, like other advisors at Grimes, who are going to coach you through, because I think we're going to continue to see this volatility over the next several weeks. Let's go on now to our big topic. And this is actually a breaking story, as the president just signed an executive order just a few hours ago that will allow alternative assets to be among the choices people have when investing in their 401ks. And my hope is many of our viewers today are investing in their 401ks. And so we know this is a big topic. We've often gotten questions about this. And our viewers don't necessarily have access to them through their traditional companies that they're with at their 401ks today. So let's start with one of our first questions. And this is Howard in Honolulu, who wants to know what exactly are considered alternative investments and why would we want them to be a part of his portfolio? Hey, Kevin, do you want to take this one?
Sure. Alternative investments is a very, very wide category of investment. It covers a lot of ground, even things that are forms of stocks and bonds. But I guess what I always say to people is that alternative investments are not publicly traded stocks and bonds. It's basically everything else. And so you could think of it as other asset classes, real estate, metals, commodities, gold, currencies, crypto. Those are all examples of alternative investments. You can have investments basically in private, private companies. So you think of private equity. These are long-term investments in companies that are not traded in the stock market. Private credit. These are baskets of loans and credit extended to companies and companies and individuals or otherwise, but it's basically private loans that are not publicly traded bonds that you can buy through your investment portfolio. So it's basically access to things outside of that. I mean, other things like hedge funds. Hedge funds can again cover basically anything, but these are funds that are managed to produce, the ones we invest in are managed to produce very stable returns. They invest across asset classes. They can short, betting against assets. They could really go anywhere and do anything. So it's basically the unregulated aspect that makes alternatives what they are. And the reason for investing in them is really probably returns, right? That'd be the big driver. And it's, but there are big trade-offs. I mean, the first one is liquidity. You can't sell many of these investments easily. So for example, if you owned a private equity portfolio, you really can't sell it at all for the most part. You have to wait for the manager to return your capital. Other investments can be accessed over time, but there are likely restrictions on when you can get your money back. So this is a big concern for investors, just something to know going into it. It's no free lunch. And another thing I guess would be that sometimes you have to meet certain criteria to even invest in these funds. So there may be things like an earnings level criteria. You have to be able to earn a certain amount of money in a year, or you must have a certain amount of investable assets to even be eligible to invest in some of these funds. So there's a lot to them. I would, they might be self-serving, but I would definitely encourage you to speak with an advisor or an expert in this area before investing. And I think it's very interesting that they're now in a 401k. Or they'll be allowed in a 401k. It'll be interesting to see exactly how that works. But there's pluses and minuses. Again, is it appropriate? But the thing about a 401k is this is a long-term investment, right? You're investing. I mean, if you're a 30-year-old, 40-year-old, 50-year-old, you're probably not touching these for decades. So it might make it appropriate for something that has less liquidity. So I hope there's some limits on what portions of portfolios can be invested, and it'll be interesting to see what the regulators come up with. But I think, in the grand scheme of things, it's probably a good thing.
Yeah, and remembering too that 401ks do have their own rules, right? So they're heavily regulated by the Department of Labor as well, and they have a lot of say over what does get offered in a plan. So Kevin was just talking about lack of liquidity and things like that can be part of the alternatives market, but these would need to be open end, probably daily liquid options available to investors. So it will be really interesting to see how this gets rolled out to the 401k investing population.
Yeah, I think that's why we call them alternatives, right? Because they are an alternative and they usually have lower correlation with the current market. So it can possibly hedge some downturns. It can maybe create some protection, but you have to have a risk tolerance to handle this, even in your 401k, which is intended to be a long-term investment. You need to be able to have the appropriate risk tolerance so that when you see these drop, it doesn't cause you to liquidate your 401k in this case. But Emily, when we think about Katrina in Texas, she wants to know what percentage of her portfolio should be offered to alternative investments.
Sure. And I don't think there is a hard and fast rule, right? It will depend in part on the overall allocation. It will depend on what types of alternative investments. Are they liquid, or do they have lockups? But I think if you're looking to really diversify a portfolio, then something along the lines of maybe 15% could be an appropriate allocation to alternatives. But again, talk, of course, to your advisor about your own specific situation, and then, in that universe of alternatives, what are we using to get to that allocation?
Yeah, I think that's right. Maybe 10 to 15% to get started, see how it goes. Talk to your advisor, but this is not one where you want to go up to 40% right away as you think about your total goals. And then Monica from South Carolina wants to know what should she even consider alternative assets? Should she be adding to her portfolio?
Well, Monica, I don't know anything about you, and so I can't give you a specific recommendation, or my chief compliance officer will come to my house in the middle of the night and take me away. But in general, things that we're looking at for alternatives, and you may want to consider for yourself after doing your diligence, would be private credit is an area I think that we really like. Again, I mentioned it earlier, but these are funds that are specialized in private loans. They pay, I think, really high interest rates, could be very attractive. They're short-term loans generally. They're variable rate generally. And so that could be a good area. We like certain hedge funds that use trading systems to smooth returns and manage risk. I think Terri was just saying it's nice to have things in the portfolio that have low correlation to markets. A lot of the hedge funds that we're using, we design them and we put them together in portfolios for that exact reason, to have low correlation to what's going on in the rest of the portfolio. So that might be something to think about. And I honestly think that the private markets, when I say private markets, the alternative investments in private markets for real estate, that's probably, in my opinion, the best way to access real estate. There's a lot of pitfalls there. Real estate is it's not like stock market where everything goes up and down together. Real estate is very idiosyncratic. It's very one-off, but there can definitely be some opportunity there. And then another area, since Joe's not here, I guess I can bring it up. We're in the safe zone. I think that Bitcoin is something to think about for very long-term investors. Bitcoin is, we look at it as a store of value. It has historically been the highest performing asset that we follow. It's also the riskiest asset that we follow, but even on a risk adjusted basis, it's attractive. And so I think Bitcoin for a small piece of the portfolio, for a long-term investor, that might be something you might want to consider after doing your homework. But again, you're really going to want to see an advisor like Emily to talk about these things and to make sure that they might be right in your specific situation.
I think that's what I really appreciate about Kevin and Emily is that they really want to know you as a person and what your wants and needs are, what your goals are. They don't want to recommend anything at all on a show like this if they don't know you. But as a fiduciary, they really need to make sure it's the best thing for you for the long term. So always keeping that in mind as you work with an advisor, make sure they are a fiduciary like Kevin and like Emily. What I'd like to do now is get to the big three stories to watch for next week. So we're focused on three now, but Kevin, the president is expected to decide whether to extend or allow the trade truce with China. What do you think will happen and what are the consequences of that?
I have no idea what's going to happen, but if I was forced to wager, I would say that it's either going to be a deal or extended. I don't think that it's going to be any sort of hard line because I think the president knows, and we all know that would be bad for the market, definitely bad. That's something I would be really worried about at this point. Like earlier, we were talking about how valuations are very high, and when valuations are high, markets are susceptible, maybe more susceptible to bad news than they otherwise might have been. And something like that would not be greeted well by the markets. So I mean, obviously, a deal, or, going forward, and some finality, some closure would be, I think, the best case scenario going forward. So we'll see. Rather than just kicking the can down the road again and again, it would be great if there was some sort of deal reached.
Yeah, if they could agree on that, I think it would be helpful. It would also be very helpful because one of the things we're always watching is our supply chains, as you know. And if a trade agreement is reached with China, I think there'll be greater certainty for all businesses to rely on, the different China-based products and to understand that, which will then ease some of the tension in the supply chain, which ultimately can help the economy overall. But the next item, and Kevin, you mentioned this earlier, we're going to get important data drops, including CPI and PPI. And so, what are you expecting there? And are there any other data points we should be watching?
Yeah. No, CPI is the big one. So looking at core inflation. So core inflation is excluding food and energy. Every month, basically, where we are right now, it's either zero point 0.2 or zero point 0.3, increase in inflation. And when you add them all up for the trailing 12, you get your year over year inflation. That's expected to be about 3%. And that kind of makes sense, right? If it was zero point 0.2 times 12, that'd be 2.4% inflation. If it was zero point 0.3 times 12, it'd be 3.6. It goes up and down, and so 3 is the midpoint there. So that's that makes sense. Last month, it rounded to 0.2 for the core, so people were really excited about that. Under the hood, there was some goods inflation that was starting to show up, so I guess the inflation hawks had something to point to there as well. The consensus for next week is 0.27, so if it's under 3, sorry, 0.3, I think the markets would like that. And if it's much more than that, then obviously that would be problematic. So it definitely could move the markets. But remember, these numbers are noisy. Just ask the recently fired U.S. Labor Secretary, right? Like, so economic numbers jump around. So the reciprocal tariffs are just being put in place. It's going to be the CPI numbers that are coming out for maybe August, September, October. They're going to be released in the future. They're gonna matter the most, and that's where the story's going to be. And it's going to go up. Inflation's going to go up. The question is it going to be kind of transient one time, or is it something more nefarious? But all that said, I think that CPI is a market mover for next week for sure. Does anyone miss the days when no one cared about inflation? Because I kind of do.
I do, definitely. And I know a lot of consumers care a lot about inflation today. And, Emily, that leads us to our third big topic, which is July's US real earnings report, which tracks the average wage flux based on inflation and other measures. There's been a downward trend for the past year, over 1 year down about 1%. How does this affect our viewers' investment decisions when their income is not improving?
Well, I think when you see your income kind of stagnate or even maybe decrease a little bit, we see people potentially start to save less. So maybe they were doing a certain amount in their 401k and now they're cutting it back, or maybe they were making, college savings contributions or adding to that emergency fund and now they're reducing what they're putting away. And in the short term, that's probably not a deal breaker for anybody, but longer term, we wouldn't want to see people really impede their savings rate. What would be potentially more concerning is that I think sometimes when investors feel pinched, they might go to their portfolio for the liquidity that they need. So that could be as innocuous as maybe you're tapping into that emergency fund that you're usually putting money into. But we also tend to see things like 401k loans can pick up. So that's people borrowing from their retirement. There are situations where a 401k loan could be appropriate, but we certainly don't like to see them just to cover the daily cost of living. So ideally, we really want to encourage people to stick with their savings wherever possible. Avoid taking money out of the portfolio just to cover the day-to-day needs. Although certainly understanding that sometimes that is what happens, unfortunately.
Yeah, if any of our viewers have, questions around liquidity or what bucket you should take your necessary cash from, I think an advisor can help you think through both the short term and the long term implications of that, and trying to not impact your 401k or take cash from your 401k when you're in your prime earning years and your prime saving years is definitely a golden recommendation for our clients. Unless absolutely needed, talk to a financial advisor for that. So that really brings us to the ending of our show. And, Kevin and Emily, I just appreciate your insights, your advice, your guidance so much for our viewers. And thank you all of our viewers. Thank you for joining us today. A reminder again to go out to wealthion.com to go over a portfolio review to get any of your questions answered. I'd also ask you to send in questions, comments for our show next week. And Emily and Kevin, you guys are superb. Thank you so much. We really appreciate it.
Thanks, Terri.
Thanks, Terry. Happy to be here.
All right. Have a great week, everyone.